Hi. In this video we will be talking about the truth about investing. Watch this video to the end to uncover the truth about investing, drawing insights from seasoned financial experts to provide you with valuable tips to navigate the world of investment with confidence and success. Investing can often seem like a mysterious realm reserved for the financially elite or those with insider knowledge. However, the truth is that investing is accessible to anyone willing to learn and commit to a disciplined approach. In this comprehensive guide, we'll uncover the truth about investing, drawing insights from seasoned financial experts to provide you with valuable tips to navigate the world of investment with confidence and success. Education is key. One of the fundamental truths about investing is that education is paramount. Before diving into the market, take the time to educate yourself about the various investment options, risk management strategies, and market dynamics. There are numerous resources available, including books, online courses, and seminars, that can help you build a solid foundation of knowledge. Financial expert Warren Buffett once said, "Risk comes from not knowing what you're doing." This statement underscores the importance of understanding the investments you're making and the associated risks. By educating yourself, you can make informed decisions and avoid common pitfalls that plague inexperienced investors. Define your goals. Another truth about investing is the importance of defining your goals. What are you investing for? Is it retirement, buying a home, or funding your children's education? By clearly defining your objectives, you can tailor your investment strategy to align with your specific needs and timelines. Financial advisor Suze Orman emphasizes the significance of setting clear, achievable goals. She advises investors to ask themselves 3 questions. What is the purpose of the money? When will I need the money? What level of risk am I comfortable with? By answering these questions, you can develop a personalized investment plan that reflects your aspirations and risk tolerance. Diversification mitigates risk. Diversification is a fundamental principle of investing that helps mitigate risk. Instead of putting all your eggs in one basket, diversification involves spreading your investments across different asset classes, industries, and geographic regions. This strategy can help reduce the impact of market volatility on your portfolio. Renowned investor Mark Cuban advocates for diversification as a means of protecting your investments. He advises investors to diversify across asset classes, industries, and geographic regions. By diversifying your portfolio, you can potentially maximize returns while minimizing risk. Time in the market trumps timing the market. One of the most enduring truths about investing is that time in the market trumps timing the market. While it can be tempting to try to predict market movements and time your investments accordingly, research has shown that consistently timing the market is exceedingly difficult, if not impossible. Legendary investor Peter Lynch famously said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves." This statement underscores the futility of trying to time the market and highlights the importance of adopting a long-term perspective. Emotions can cloud judgment. Emotions play a significant role in investing, often clouding judgment and leading to irrational decision-making. Fear and greed are 2 primary emotions that can drive investors to make impulsive choices, such as buying at market peaks or selling during downturns. Investment guru Benjamin Graham famously said, "The investor's chief problem, and even his worst enemy, is likely to be himself." This statement highlights the importance of controlling emotions and adhering to a disciplined investment strategy, even in the face of market volatility. Consistency is key. Consistency is another essential truth about investing. Rather than trying to chase hot stocks or time the market, focus on consistently contributing to your investment portfolio over time. By adopting a disciplined approach and sticking to your investment plan, you can harness the power of compounding and potentially achieve your long-term financial goals. Financial planner Dave Ramsey advocates for consistency in investing, emphasizing the importance of staying the course even when faced with market fluctuations. He advises investors to stick with a long-term, diversified investment strategy and avoid trying to time the market. Fees matter. Fees can significantly impact investment returns over time, making it essential to pay attention to the costs associated with your investment products. Whether it's management fees, trading commissions, or expense ratios, these fees can eat into your returns and diminish the growth of your portfolio. Indexing pioneer John Bogle famously advocated for low-cost investing, founding Vanguard Group to offer mutual funds with minimal fees. He believed that high fees erode investor returns and that minimizing costs is crucial to long-term investment success. Stay informed, but avoid overreacting. Staying informed about market developments and economic trends is essential for making informed investment decisions. However, it's equally important to avoid overreacting to short-term fluctuations or sensationalized news headlines. Instead, focus on the long-term fundamentals of your investments and resist the urge to make impulsive changes to your portfolio. Warren Buffett advises investors to be fearful when others are greedy and greedy when others are fearful. This contrarian approach underscores the importance of maintaining a rational mindset and avoiding herd mentality in investing. Understand the power of compounding. One of the most compelling aspects of investing is the power of compounding. Albert Einstein famously referred to compound interest as the eighth wonder of the world. Compound interest occurs when the interest earned on an investment is reinvested, leading to exponential growth over time. Financial experts often emphasize the importance of starting early to take full advantage of the power of compounding. Even small contributions to your investment portfolio can grow significantly over time with the help of compounding. By reinvesting your dividends and allowing your investments to grow over the long term, you can harness the power of compounding to build wealth gradually. Asset allocation is crucial. Asset allocation is a key component of any investment strategy, determining how you distribute your investments across different asset classes such as stocks, bonds, and cash equivalents. The goal of asset allocation is to create a balanced portfolio that aligns with your risk tolerance and investment objectives. Financial advisor William Bernstein coined the term, the only free lunch in investing, to describe the benefits of asset allocation. By diversifying your investments across various asset classes, you can potentially reduce risk without sacrificing returns. Asset allocation allows you to spread risk across different types of investments, ensuring that your portfolio remains resilient in different market conditions. Have a long-term perspective. Investing is a long-term endeavor, and successful investors understand the importance of having a patient, long-term perspective. While short-term market fluctuations are inevitable, focusing on the underlying fundamentals of your investments can help you weather temporary downturns and capitalize on long-term growth opportunities. Renowned investor Warren Buffett is known for his patient, long-term approach to investing. He famously remarked, "Our favorite holding period is forever." Buffett's investment philosophy emphasizes the importance of investing in high-quality companies with strong fundamentals and holding onto them for the long term, regardless of short-term market fluctuations. Stay disciplined during market volatility. Market volatility is a natural part of investing, and it's essential to stay disciplined during periods of uncertainty. While market downturns can be unsettling, it's crucial to avoid making impulsive decisions based on fear or panic. Instead, focus on your long-term investment goals and stick to your predetermined investment strategy. Financial advisor Carl Richards advocates for maintaining discipline during market volatility, advising investors to stay the course and avoid making emotional decisions. He emphasizes the importance of having a well-defined investment plan and sticking to it, regardless of short-term market fluctuations. Consider dollar cost averaging. Dollar cost averaging is an investment strategy that involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach can help reduce the impact of market volatility on your investment portfolio and potentially lower the average cost per share over time. Investment guru Benjamin Graham advocated for dollar cost averaging as a means of mitigating the risk of market timing. He believed that consistently investing a fixed amount of money at regular intervals could help investors build wealth steadily over time, regardless of short-term market fluctuations. Be tax efficient. Tax efficiency is an often overlooked aspect of investing, but it can have a significant impact on your overall investment returns. By minimizing the taxes you pay on your investment gains, you can potentially increase your after-tax returns and accelerate the growth of your portfolio. Additionally, he recommends investing in tax-efficient investment vehicles such as index funds and municipal bonds to minimize taxable income and maximize after-tax returns. Rebalance your portfolio regularly. Portfolio rebalancing is the process of realigning your investment portfolio to maintain your desired asset allocation. Over time, changes in market performance can cause your portfolio to drift away from your target asset allocation, leading to unintended risk exposures. Renowned financial advisor Burton Malkiel recommends rebalancing your portfolio at regular intervals to ensure that your asset allocation remains in line with your investment objectives. He advises investors to sell high and buy low by selling assets that have appreciated in value and reinvesting the proceeds into underperforming assets to maintain the desired asset allocation. Stay informed about investment costs. Investment costs can have a significant impact on your overall investment returns, so it's essential to stay informed about the fees and expenses associated with your investment products. Whether it's management fees, expense ratios, or trading commissions, these costs can eat into your returns and diminish the growth of your portfolio over time. Indexing pioneer John Bogle famously advocated for low-cost investing, founding Vanguard Group to offer mutual funds with minimal fees. He believed that high fees erode investor returns and that minimizing costs is crucial to long-term investment success. By choosing low-cost investment products and avoiding unnecessary fees, you can potentially increase your investment returns and accelerate the growth of your portfolio. Seek professional guidance when needed. While self-directed investing can be rewarding, there may be times when seeking professional guidance is warranted. Whether it's for complex financial planning strategies, tax optimization, or investment advice, a qualified financial advisor can provide valuable insights and expertise to help you achieve your financial goals. Financial advisor Suze Orman emphasizes the importance of seeking professional guidance when needed, particularly for complex financial matters such as retirement planning and estate planning. She advises investors to find a financial advisor you trust and work with them to develop a personalized financial plan tailored to their specific needs and objectives. Stay focused on your long-term goals. In the midst of market volatility and economic uncertainty, it's easy to lose sight of your long-term investment goals. However, successful investors understand the importance of staying focused on their objectives and resisting the temptation to make impulsive decisions based on short-term market movements. Investment guru Warren Buffett is known for his unwavering focus on long-term value creation. He famously remarked, "The stock market is designed to transfer money from the active to the patient." Buffett's investment philosophy emphasizes the importance of staying disciplined and maintaining a long-term perspective, even in the face of short-term market fluctuations. Embrace continuous learning. The world of investing is constantly evolving, with new technologies, market trends, and economic developments shaping the investment landscape. As such, it's crucial to embrace continuous learning and stay informed about the latest developments in the financial markets. Renowned investor Charlie Munger once said, "In my whole life, I have known no wise people, over a broad subject matter area, who didn't read all the time, none, zero." This statement underscores the importance of continuous learning in investing. Whether it's reading financial publications, attending investment seminars, or following reputable financial news sources, staying informed can help you make better investment decisions and adapt to changing market conditions. Practice patience and persistence. Investing is not a get-rich-quick scheme. It requires patience and persistence to achieve long-term success. While the allure of quick profits may be tempting, successful investors understand that wealth accumulation takes time and discipline. Financial expert Dave Ramsey often emphasizes the importance of patience and persistence in investing. He advises investors to stay focused on the long term and avoid chasing short-term gains. By remaining patient and sticking to your investment plan, you can weather temporary market fluctuations and achieve your long-term financial goals. Manage risk appropriately. Risk management is an integral part of investing, and it's essential to manage risk appropriately to protect your investment capital. This involves assessing your risk tolerance, diversifying your portfolio, and implementing risk management strategies such as stop-loss orders and asset allocation. Investment guru Peter Lynch once said, "The key to making money in stocks is not to get scared out of them." While taking on some level of risk is necessary to achieve higher returns, it's crucial to strike a balance and avoid excessive risk-taking. By managing risk appropriately and diversifying your investments, you can potentially minimize losses and preserve capital during market downturns. Stay calm during market turmoil. Market turmoil and economic uncertainty are inevitable parts of investing, but it's essential to stay calm and avoid making impulsive decisions during periods of volatility. Emotions such as fear and greed can cloud judgment and lead to irrational decision-making, so it's crucial to maintain a rational mindset and stick to your long-term investment strategy. Investment legend Benjamin Graham famously remarked, "The investor's chief problem, and even his worst enemy, is likely to be himself." This statement underscores the importance of controlling emotions and maintaining discipline in investing. By staying calm during market turmoil and focusing on your long-term investment goals, you can avoid making costly mistakes and capitalize on opportunities that may arise. Monitor and review your portfolio regularly. Monitoring and reviewing your investment portfolio regularly is essential to ensure that it remains aligned with your investment objectives and risk tolerance. This involves assessing the performance of your investments, rebalancing your portfolio as needed, and making adjustments to your investment strategy based on changing market conditions. Financial advisor Carl Richards often emphasizes the importance of reviewing your investment portfolio regularly to ensure that it remains on track to meet your financial goals. He advises investors to take a step back and assess their portfolio's performance objectively, making adjustments as needed to stay on course. Stay flexible and adapt to change. The financial markets are dynamic and ever-changing, so it's essential to stay flexible and adapt to evolving market conditions. This may involve adjusting your investment strategy, reallocating your portfolio, or exploring new investment opportunities to capitalize on emerging trends. Investment guru Warren Buffett is known for his flexibility and willingness to adapt to changing market conditions. He famously remarked, "The investor of today does not profit from yesterday's growth." Buffett's investment philosophy emphasizes the importance of staying flexible and continuously learning in investing. Stay focused on the long-term horizon. Finally, it's crucial to stay focused on the long-term horizon and resist the temptation to make short-term, speculative bets. Successful investing is about patience, discipline, and a steadfast commitment to your long-term financial goals. Financial expert Suze Orman often emphasizes the importance of staying focused on the long term in investing. She advises investors to stay the course and avoid making impulsive decisions based on short-term market movements. By maintaining a long-term perspective and sticking to your investment plan, you can navigate the ups and downs of the financial markets with confidence and achieve your financial objectives. Conclusion. In conclusion, investing is a journey that requires patience, discipline, and continuous learning. By embracing these principles and adopting a long-term perspective, you can navigate the complexities of the financial markets with confidence and success. Remember to stay informed, manage risk appropriately, and stay focused on your long-term financial goals. With the right knowledge and mindset, you can build wealth steadily over time and achieve financial security for the future. Thanks for watching. If you found this video helpful, please give it a thumbs up, hit that bell, comment, and subscribe for more content on the International CEO. See you next time.